Hey, everybody. It's going to be a great conversation today about the housing market. We're seeing a lot of things change that are happening on the ground right now. We actually just got the report out this morning saying that consumer sentiment is one of the worst levels in history. And obviously, if people aren't feeling good about the market and the housing market, or they're just having issues, even with the oil prices, gas prices, things like that, they're not going to go out there and buy their largest financial investment. And that is what is really pushing back the market at this point in time. So we're going to go over a lot of information today. If you are a investor, a seller, a buyer, a real estate agent, this information is so important to help you make the best decisions possible for you and your family moving forward. Hey, thank you for that. Sounds good. I'm glad you guys can hear me. Got that figured out. So I'm going to go ahead and jump into the presentation here. And then if you have questions along the way, go ahead and drop them in the chat. I'll come and revisit them, and I'll be watching the chat here. So appreciate you guys hopping on, having lunch with me this April 10th, Friday before the weekend. It's going to be a great weekend here. Got an Eric Church concert tonight, so I'm very happy about that. One of the best country stars ever. So let's go ahead and jump into today's presentation. All right. Can you guys see everything okay? Yeah, perfect. All right, let's rock and roll. So the number one thing I want to focus on is this data just came out this morning. Consumer sentiment hit record low based on these inflation fears that are caused by the Iran war. Of course, there's been an announcement of a ceasefire, which nobody really believes because there's bombings going on during this ceasefire. Iran's trying to do tolls to people passing through the strait. And the stock market has rallied saying, hey, this issue's over. Meanwhile, it's not, but the consumer and the bond markets aren't believing what's happening in the stock market. So we're seeing kind of a weird market reaction between the bond market and the stock market. And I can tell you, I think the bond market is the smart market. And then I think, I'll just leave it at that. But the stock market has gone up about 8.5% just over, since March 30th when we hit the low, because people are saying this is all going to get figured out. But prices are still $99 for a barrel of oil. So this is a huge problem. We're up from about $60 barrel oil. And every time this has happened, there's a recession that follows. And I think this is really important because there's a recession that follows. Obviously, it's going to slow down real estate, which is already going into a massive slowdown, especially here in the Sunbelt areas. That's going to severely impact if you're in real estate, it's going to severely impact your business. So this is something that you definitely want to stay in touch with. It's a great thing that the stock market is up and near record highs. We're only like 1.5% below record highs at this point in time. And this is really good for areas like Florida where people use their 401k money. They use the money they have on the sideline to be able to go buy more and more real estate. So we're happy to see that the market's up if you're a bull, but the reality is that the bond market has not reacted and interest rates have not come down as much as people have hoped because there's still tons of inflation fear out there in the marketplace because of these oil prices. So it's kind of this interesting mixed market that we're seeing out there this week. Now, the bubble is real. Okay, I don't really care about what the bulls say. We go through boom bust cycles in the United States. Yes, there's steady eddies up in the Midwest and the Northeast because they have these, not in my backyard people you can't build. There's not a lot of speculation. It's very challenging, but they have their own issues. They have aging inventory. They have young people who are leaving the states. We can show that GDP loss from these high cost, high tax areas. People are leaving, but this bubble is absolutely real. Look at this run up in the 2006 bubble. We have just as much of a run up here in the 2025, 2026 bubble, and it's already peaking off. I'll show you a chart that shows if you've owned real estate for the last 4 years, you've basically broken even, with your principal pay down versus what you need to do to upgrade and maintain your property. But it has not been a strong asset class for the last 4 years. It's spooking a lot of investors now because we're seeing rental prices go down. So, comment below. Are you seeing this in your area? We're definitely seeing it here where I am in Jacksonville, Florida. I'd love to hear where you're at and what you have going on. But there's a lot of things going on under the surface that the media is really not picking up on and putting out there. But ultimately, if you're hearing those stories that we're not in a bubble, it couldn't be further from the truth. Of course, we're in a bubble after a 63% run up in home price appreciation in 3 years. Just focus on this. We had 10 years of demand that happened in 3 years. Okay, it's a demand shock that came into the system due to low interest rates, due to speculators, due to government policies. once again, that created this bubble that we're looking at on this chart. And I think that's a really important thing to take away. This is not a normal environment. This is one where it's completely inflated, where we now have the worst affordability that we've ever had before. And this is a study that came out from that ranks Florida dead last for renters in the US for housing costs, consuming 37% of incomes. 37%. So not only consumer sentiment is the worst, but 37% of somebody's income is going to live for their shelter costs, the place where they just go to sleep at night and they wake up and they pay 37, they work their job, 37 cents on the dollar that they make goes to that. That doesn't even include the money that they have to pay to the government just to work. So this is a really hard and challenging issue. The affordability crisis is absolutely real. Different areas have different issues, but I can tell you Florida, the wages are not keeping up with the housing prices, even though they're building. And now we're starting to see what we call mean reversion. So we have this massive run up. Now we're going to mean revert, and rents and prices both are now starting to come down. So thankfully, the renters and the owners, the recent buyers are starting to get a little bit of help on the sidelines, which I think is really important. But in response to that run up in basically demand collapsing, right? If we had 10 years of demand in 3 years, and you can expect 7 years of basically low demand until wages keep up and there's natural demand that reoccurs. But in response, sellers are cutting their prices at record rates as they chase down the market, because sellers are putting their house on the market. They're not getting a single buyer out there. The houses that are priced correctly and are in great condition and they're in prime areas, they sell like hotcakes. Okay. But most sellers are not realistic on what the real price is. And they're also not realistic on the condition of their house. And that's why those houses that just sit, I mean, they're not getting any views, and they slash, they blame their real estate agent. And then they rage quit their house. They pull their house off the market and try to list with somebody else, or they pull it off the market and they try to find another solution. Hey, I'm going to list later when the market is better. It's not going to get better anytime soon. We are still priced of real estate at 3% rates when rates are now 6.5%. It takes time for those prices to adjust to a 6.5% rate environment, and it will take years for that to play out. But we will see a steady decline in what's happening with prices. But supply is increasing, and it's not just in Florida and Texas. This is really important. It's across the country. A lot of people say, oh, it's only Florida and Texas that are having issues. No, that couldn't be further from the truth. Look at this. Washington State, 64.4% increase of inventory, 17,000 active listings. Colorado is one that's a really big one to talk about. Tennessee, Arizona, Texas, of course, Utah, DC, right, with what's been going on with Doge and the cuts, Oregon, Georgia, which, you know, is close to me. Florida didn't even make the top 10 list. They're number 12 on this list, which is really interesting. So, even though Florida is having a lot of issues, we just have this demand that has just, dropped through the floor. There's even areas I'll show you that people are leaving Florida, and the net domestic migration is actually negative, and that can kill the real estate industry, which is really important because in Florida specifically, real estate accounts for 19 to 24% of the GDP. And it has a massive multiplier effect, right? You buy a house, you paint, you rehab, you buy appliances, you buy furniture, you buy all of this stuff, and it has a multiplier effect. So when it slows down and the velocity of sales have slowed down, we're grinding along the bottom for the number of sales. It's really bad for all of these other industries, and it's causing mayhem. And that's why we're starting to see, sellers finally say, you know what, I'm going to start reducing my price because I can't get my property moved. And that's good. That's going to continue moving forward. Thankfully, we've seen just in the last 2 to 3 weeks, a lot of sellers starting to give up and say, you know what, I will price my house where the market will accept it. And they reduce it $50K, boom, it sells. That becomes the next comp. And then the next seller has to sell their house for that price or less. And that's basically what we're seeing, unless demand miraculously comes and turns back around, which I don't see happening anytime soon with oil prices being elevated. The only way I would see that is if we saw rates go back below 6%, which we had for just 2 weeks. That was a really great time period where we saw a flurry of demand. But what's interesting, what we're seeing right now is we're seeing high price homes, $1 million, $2 million, $3 million, they're selling. They're selling like hotcakes. But the mid-price homes, because the middle class is so squeezed right now, they don't have any more money to buy real estate or anything like that. the middle class is completely gone. That's what we're describing as the K-shaped economy. The top 10%, their wealth is growing astronomically. The bottom 90% are getting poorer. The rich are getting richer. And we're seeing that show up in our local numbers as well when people are going to buy a house. Now, this is a great chart that came out that shows just that builders are pulling back, right? They're seeing that the demand is sliding really quickly. And they're saying, look, if demand's sliding, we're going to slow down our supply. So future supply of inventory coming on is starting to become a lot less. They're seeing obviously oversupply, higher interest rates. It's less attractive to build in that environment. And obviously decreasing rents is the number one factor that's going to drive this market down. If you have to think about one thing that's going to, why? Because it's an opportunity cost. The buyer says, hey, I can rent that same house for X amount. Why would I, if I can renegotiate my lease down, $300, $400, $500, why would I go out and pay an extra $1,500 a month to buy a house? In a lot of circumstances, the average buyer would rather pocket that $1,500. So until the math makes sense and they have to chase those rents down by dropping the price to make the payment make sense, we're going to see a situation where we could see less building moving forward because of this issue and the demand until the demand comes back, which, demand could come back in 3 to 5 years. Naturally, if wages keep up, but with the AI situation, I'm not so confident in that. But obviously we have an oversupply. You can see here, we had this massive run up of apartment rents just going up 16%. I don't know if you've had this experience before, drop a comment below, your rent's just skyrocketing. We had a bunch of rentals. We had over 200 units. We had to raise rents because our insurance went up. Our taxes went up. It wasn't anything that we were trying to milk the tenants for more money. It's just our expenses continued to move up and we passed those expenses on, obviously, to the renters who are renting from us. And in certain circumstances, we'd even show the renters, hey, this is what our bill is from last year to this year. This is the government. This is the insurance market that we're in. And this is how much more we have to pay. And unfortunately, we have to pass it on to you because all the other rents in the area moved up. Well, now that circumstance is reverting right back. You can see that right when the Fed raised, the Fed funds rate pushed mortgage rates higher. We went from 3% all the way down to 6.5%. Apartment rent started to decline. And I think we're going to continue to see a declining market every single year for apartments. So now if you're a renter, you are totally in control. If you're an investor, you need to be worried about this, especially if you're in an area that has a lot of competing multifamily or single family. So those of you just joining us right now, go ahead and drop a comment below. I'd love to hear where you're joining us from. Give me a like. I appreciate you guys, spending your time with me this Friday afternoon, and just appreciate you watching the channel. I'm on here every Friday sharing the newest real estate data that's coming out, some thoughts of what's going on in the local market. And then if you have any questions, I answer all the questions at the end. So I'll be on the lookout for that. But Florida has the biggest rent cuts since 2022. You can see this, obviously, the top 7, 8, 9, 10. Basically, all of these are just slashing prices. In our market, we're down 20% on rents, right? So how can you, as an institutional buyer, a hedge fund, or even a mom and pop, which are about 90% of the market, that wants to go buy a piece of real estate, the rents are down. The rents are down. You can start negotiating. Please get out there. I had somebody who is a subscriber reach out to me and say, hey, I negotiated 4 months free rent and $200 off my rent because I threatened to switch apartment complexes, and they just agreed to his terms to keep him in place because he was a really good tenant. So start negotiating. You now have the power, and this completely redoes the math for the investors. Now, one of the things that we're also seeing is that when the sellers can't sell their house, they turn around and become what we call an accidental landlord, which means they either don't have enough equity or they're just not willing to give up the property. So they turn it into a rental property. And this is flooding the market with rentals. We are seeing a lot of this locally, especially the veterans and the FHA that only put 0 to 3.5% down. It's crazy, but you can see obviously Denver, Colorado, inventory is spiking. Austin, Texas, which is the worst city in the country for real estate right now. And Jacksonville is one of the worst behind that. I think Punta Gorda, some South Florida areas as well, Tampa, Phoenix, Arizona, we're seeing massive run-ups compared to what we saw in March 2019. And 2019, honestly, was not that great of a year for real estate either. We thought we were going into a recession that year. But we're seeing, what happened in New York. These are the Northeast areas that just did not build. They did not have the wild speculation, but their inventory is down. So this is a really interesting market where you can't even compare nationally. because I feel even regionally in Florida, even just as statewide, you can't even compare some of the markets in Florida because some are so unique with their setups, how much wealth they have for the area, if the people there have already made their money, what the working class looks like, what the job market looks like. It's so unique. So real estate's very micro, but you can see the areas that are starting to fall apart first are these areas that had the highest level of speculation driven up by the zero interest rate policy of the Fed. And we're going to continue to see the pain as that resets because it was just too much speculation, just like what we saw in the run up from 2003 all the way up to 2007. It was an incredible run up. We saw an incredible run up again, and now these areas specifically will get hit, and we'll see those accidental landlords continue to pop up and rents continue to drop. Now, this is what I was talking about, how real estate investors have basically, they're betting on 3 to 4% appreciation every single year. They're betting on rents going up every single year. And now we're not seeing appreciation go up 4% a year, and we're not seeing rents go up. We're actually seeing both go down. So, these owners in real house price terms, when you consider inflation, they're losing wealth in real terms. So, of course, they are getting principal pay down when they pay their payment every single month, but there are carrying costs associated with these properties, with maintenance and repairs that eat up a lot of that. And unfortunately, most investors do not, especially the multifamily guys, the single family guy, they do not track how much it actually costs them to turn the units, to replace the roof, to do the HVAC, etc. And all of a sudden they're very surprised that their properties don't cash flow as much as they thought it did. And it's a huge problem. So those investors that, obviously bought, 2018 and they refinanced and got a low rate, they're probably doing just fine. But the people who bought investment properties in 22, 23, 24, 25 in the Sunbelt areas, they're really, really hurting. And that's where we're starting to see some of the distress show up already. Now, obviously, when you have distress and the demand is dropping, you're starting to see a ton of stale inventory. The stale inventory is basically 60 days plus where it's just sitting on the market with not a lot of activity. And we're at a record high for the month of February at $347 billion of real estate that's just sitting on the market, stale, active for sale. And this is a really interesting, concept, which how much of it is just stale. And ultimately, if the sellers want to sell, they're going to have to start reducing the price. So this is a great thing if you're a buyer looking to negotiate. If you need a real estate agent in your area, just be aware 80% of real estate agents don't produce enough to actually help you in the transaction. If you want to get in touch with a top real estate professional, reach out to me. You can email me. I'll make sure you get in touch with, one of the best. Just give me an explanation of what you're looking for, what communities you like, your price point, your time frame, and then I'll be sure to get you in touch with one of the best agents in the marketplace. I personally own a real estate brokerage with 280 agents in Northeast Florida. We also in Southern Georgia, and we connect with the top people around the country all the time. We do about $600 million in transactions each year, and we're growing at about a 20-25% rate for our headcount, which is awesome. So we'd love to help you if you need help. But look, you are in control now if you're in a buyer in most markets here in the Sun Belt, which is fantastic, unless, again, you're in the luxury market with, looking at inventory that is very unique. So this is another narrative that's going around that I really want you to pay attention to. This is states with the highest migration in 2025. And look at the pattern. It's changing, right? It used to be Florida and Texas, and it still is Texas, but the domestic migration is very low. You can also see North Carolina. And now we're noticing in 2026, there's negative net migration in some of these areas that had this massive run up. But you can see, North Carolina, you can see Texas, South Carolina, et cetera, down the line. Florida is just, look at this, 0.1%. And that's net domestic migration. So I think this is a huge issue. We're already negative in some of the cities around here. And if you don't have the demand with that also has the money to be able to purchase at today's rates, at today's prices, that real estate's not going to transact. So it's a matter of these sellers realizing that the market is no longer what it was in 2021, 2022, and getting your sellers to recognize this. The best thing you can do is just show them the math of what they can rent that exact house for, show them what the monthly payment is for that house versus the one that they have right now, to really explain to them, hey, like, this is what it is now. Would you be buying this house at that price with this payment today? away, or would you want to negotiate? And that's something, of course, the seller wants the most money possible, but they also need to be realistic of where the market is today. And I think the sellers that don't sell quickly, they're going to be in a lot of trouble. Because look at this. This is a similar setup. Does this look familiar to you? This is the housing sequence of the 2008 case study, right? In summer 2005, new home sales peak, right? We had that already. Then we had the building permits peak in 2005, right? This doesn't happen overnight. I think a lot of people with real estate get confused. It's in a liquid asset classes. The builder is always behind. They build to try to catch up with demand, and then demand slows down, and then they overbuilt. This is just, it just replays over again, because it takes 2, 3, 4 years to build some of these projects. It's not something that happens overnight where they can just catch the demand and just boom, there's a ton of real estate out there. So they have to plan ahead. And if they get that planning wrong, it can cost them dearly, right? And then we have May 2006, underwater construction peak, units under construction peak. We already had that as well. Residential construction employment peaks. We already had that. Right. And it's going lower. Early 2007, new home prices peak. And then it just goes to this completely unsustainable period. And you can see it's right. It's 2005, it's like 3 years for this to play out. And this is why I think a lot of people are like, oh, John, you're a crash, bro. It's like, no, what I'm not going to say is going to crash tomorrow. This could be a decade structural decline to the housing market, especially here in the Sun Belt, in these areas that were over speculated. But the next step is job loss and home price decline. This is where we're at. We're already seeing this, right? We're seeing like record layoff announcements, and home prices are starting to decline across the board. Rental prices are starting to come down. So this is just another part of the cycle. I don't think people should be surprised that after this large of a run up that we would see prices start to come back down. But we're still seeing the people say, oh, prices are still going to go up 4% every single year. So like we have the real estate. It's priced on payments. We're at the maximum payment right now. The consumer is maxed out. They have debt, student loans, credit card loans, car loans, everything. We have freaking Klarna now with buy now, pay later. People are financing their delivery burritos. It's out of control. And, you have to ask yourself, who is the next marginal buyer who's going to be buying my real estate? And then who's going to be the next one who's going to be buying it from me in 30 years from now? Because people aren't having kids. They're not getting married. Okay. They're not even drinking anymore. So like the market is completely changed here. And if you're a real estate investor thinking long-term, you would have to assume what would save you would be, it would be immigration, that we'd be bringing people outside of the country. If we're not going to have, start families and have kids, inside the country, you would have to imagine that. And if that doesn't happen, then we're going to have a ton of real estate that's just sitting vacant. And right now we have 15 million units of vacant in the United States between second homes, home sitting, houses for sale, all of that stuff. And a lot of these folks who have the baby boomer situation, the silver tsunami, the Harvard study came out that said 48 million baby boomers sadly will pass away in the next 20 years. And that's where the majority of the wealth is owned for real estate. That's going to go to through an estate. Charles Schwab says that 70% of the homes that go through an estate are planned to be sold. These houses are going to be sold. They're going to need to be upgraded. There's going to be a lot of rehab that's going to need to be done with them. And that's going to be a slow drip of inventory that comes onto the market every single year, in addition to the new construction. And there's just going to be not as much demand down the line domestically because people aren't having as many kids as they did in the past. And I think it's going to show up really big in 20 to 30 years from now. And it's something to think about when you're going through the cycle in terms of, hey, is this going to be a structural issue for the real estate market moving forward? Now, this is interesting. I had a great conversation last week with John Wake, who's a housing researcher out of Arizona, and he puts out some great content that I think everybody should follow him on X. But this is one of the things that we're talking about. The 30-year mortgages were invented in 1954 to sell more debt, okay, to get that payment lower. It's not to make it more affordable, okay? There's a difference between affordability and accessibility. Accessibility is they lowered the payment so more people can access the payment, but that does not make it more affordable. It just extends the term, making it less affordable because you pay more interest. So a lot of people don't know how amortization schedules work. An amortization schedule means that you're paying the majority of the interest up front and you're paying a little tiny sliver of the principal amount. Well, in 10 years, you've basically paid, 70% of the house in interest in some cases. And it's quite crazy when you run the math on the interest that you pay over a 10-year period. Well, people only stay in their house for 10 years. Okay. That's why the mortgage rates, the 30-year mortgage is tied to the 10-year treasury bond, is because that's the duration of the average mortgage. So we invented this, extension to 30 years. And I think that, it's silly that we get these proposals for 50 years, because that makes it even worse. Basically, you're enslaving yourself to pay the bank for an entire lifetime. The idea of the 20-year mortgage was you would work for 20 years, pay off your mortgage, and then live debt-free on your house. And that would be your retirement. And that would make sense because your costs would just dramatically drop. You'd save about 25% of your income. And now, with extending the debt, from 20 to 30 years, that delays that payoff if people even hold it for 30 years. Again, most people don't stay in the same spot for 30 years. It's not as common as you would think. And we were sold this American dream, but other countries are still on 20-year mortgages. And I think that's it makes a huge difference when you're looking at the amortization table in terms of how much interest you pay and what the level of actual paid off home ownership is. Now, we have the lowest free and clear home ownership rate in the developed world. That's because we have an entire financial system that is built around creating debt for homeowners to, basically use to fund their life. And they use their house as an ATM. That is not a normal way of thinking for a lot of other people. And I think it's unfortunate. We live in the ultimate consumer economy. But what happens, and I want you to drop the question, the answer to this below, what happens when the middle class is completely tapped out? What happens when they have no more money that they can borrow and extend on? Because I feel like we're just about there. And I think that's where you start to see the end of this kind of debt cycle. I think Ray Dalio talks a lot about this, not just from the consumer standpoint, but from the US government standpoint, where it's the same thing. The government is just spending a ridiculous amount of money. There's zero accountability. We don't even know where the money goes. But we're still expected to pay, up to 40 to 50% of our income to the government, and we don't even know where it's going. So there's a lot of loss of confidence in the system at this point. So it is interesting. It's something that's been going on for a very long time. And there's going to be more financial products probably in the future that, the government or banks will start pushing to make you in debt for the rest of your life, so they can continue to get as much interest off of you, get your deposits in their bank, lend it out 10 times, and just make as much money as humanly possible. That's the game plan. So it's something for you to be aware of if you're, an investor or looking to buy your first home. This is how it's set up. And I think, even for me, I have a loan on my house. I'm prepaying it. I'm paying it off early, even though I have a 2.75% rate. And a lot of people say, well, that's crazy. Well, look, I don't think it's crazy at all. I think it's something where you are paying for peace of mind, and you have your bunker of defense that you have for you and your family, where if anything ever goes wrong, you have a paid off house. And I think it's a really, does it make financial sense mathematically? No, absolutely not. It does not make sense to do that mathematically, but it's a mental thing that I think is a security blanket for you and your family. But it's a personal decision for everybody if you can actually swing it. So that is the presentation for today. And I'm going to jump into answer any sort of questions that you all have. I do a release of a video on Tuesday of a ton of information. Sometimes I interview special guests, and then I come on Fridays at 11 or 12 to do a live to answer any questions they might have. But the question I have for you is, do you think housing will actually hold up this year, or will it go negative? A lot of the revisions of the forecast have actually come down, about 1 to 2%, depending on the revision of whether it's Zillow, realtor.com, the National Association of Realtors. And where are you, and what are you currently seeing on the ground in your market? So with that, I'll go ahead and open up the floor to the group, and we'll see if we have some more conversations here one-on-one with everybody here. And I appreciate if you give me a thumbs up and drop a comment. I appreciate you guys supporting the channel. So let's go. There's very few homes available in Suwannee after many other houses have been unlisted. What's your perspective on this issue for the valuable information you provide? So yeah, so there is a phenomenon of dropping inventory right now. And again, that is because, but if you take inventory and you bring rental inventory and you bring in active for sale inventory, it's huge. Okay. It's a massive explosion. So I think people forget this is two things. It's the rage quitting of sellers getting really frustrated. They can't sell their house. They yank it off the market and they try again later. Or number two is because they're an accidental landlord and they turn it into a rental, and now the rents are coming down because there's so many rents. Okay, so that's what we're seeing. We're seeing people take their house off the market, but it's not actually off the market. They're just transitioning it into being a rental property. And that's why you see, if you just look at active listings for sale, it looks like rent, it's coming down 10-20%, and you're thinking the market's stabilizing. It's not stabilizing. It's actually worse. It's a symptom of it being really bad because the rental inventory is exploding. Does that make sense, Anna? I hope I explained that pretty well. The Midwest, I see a new build bought in 2023 selling at a loss. Yeah, isn't that crazy? Well, generally, the rule of thumb is if you own a home for less than 5-7 years, you're going to lose money just on the transaction cost, because it costs about 10% round trip to buy and sell real estate. And then it's obviously going to cost you a certain percentage every single year to maintain your real estate. House poor is going to catch up. John, I see live, still looking for rental in Gallatin. And if you still have difficulty getting through the rental management companies, it's so frustrating. Yeah, it is really frustrating. These rental management companies want to have the least amount of communication with you. They want to basically, qualify you without even talking to you. It's really hard to negotiate with them, but you can do it. There's certain things that you can say. And if you want to reach out to me, I can more than happy to email you what I've shared with some other people on, hey, here's some tips and tricks to be able to negotiate with the rental company, show them the comps, show them what you're doing. And this can all be done in the email and text message as well, and let them know that that you have options and you're going to switch if they don't match it. So there's things that you can do, Patrice, to be able to help on that. So it's pretty much everywhere in my areas. Houses are back to 2021. Flash Dumper, where are you at? We're not at 2021 prices yet. We're going back in Florida. We're back to almost 2022, 2021 prices. But it depends on the area. It has to be around new construction. But a lot of the areas still haven't declined as much. It's going to take a little bit longer than people think. So let's see. John, I see a little bit of different situation here in Colorado. New builds, 1 mil plus are sitting, even with all the incentives. They are moving slow. No one wants them. Crappy quality. What's moving is the 500. That's a good point, Flash, because your middle class is completely different than the middle class of Florida. That is 10K less of income amongst the general population of the United States. So your area is a little bit different. Let's just put it that way. Each market has different amounts of wealth and different levels of the middle class on which is their target range. But I do have a friend who's a developer out in Colorado, and he's got, a ton of houses that are 2, 3, 4 million. And he's saying the same thing. He's like, these things are sitting. It's really hard. I'm lucky if I break even, that type of stuff. And if, this war continues and rates remain elevated for some time, we could really see some massive issues in that state. Colorado rent is funny to watch. Lots of 3 to 4 months rent and 1K gift cards. Yeah, if they have to give you a gift card, it's the rent's overpriced. But remember, they can't reduce the rent amount because it's going to impact their refinances. Because they have to go back and refinance. Maybe they did a 3-year loan, a 5-year loan. The loan's coming up. They're giving up their 4% rate. They have to refinance it at 5 or 6%, and it messes up the entire thing. So for the underwriting, they try to keep the rents as high as possible. They'll do anything else before reducing the rents because it won't pencil out for the underwriting for them to get the refinance. Let's see. Have you ever heard of Mitch Vexler of Texas? He's making... Coordinating valuation, you think some of most cities are underwater? Yeah, so cities are having a huge issue. So, we have this movement in Florida for the property taxes and getting rid of property taxes. And most of those gains, just like the BBB, will just go straight to the top. The majority of the gains will be if we got rid of property taxes. Well, who pays the most property taxes? It's the investors, which, isn't part of this bill, but it's the primaries that have the highest level of valuation, which are the most expensive homes. They're going to get the largest amount of benefit from eliminating taxes. We already have what's called the homestead exemption, which you're exempt on your first $500,000 anyway. So it doesn't help those people at all. It helps the people who have these, mega mansions in Florida. So, and we're already under distress in a lot of circumstances. There's a lot of waste, I don't know if it's fraud, but there's definitely a lot of waste where people, they get in charge of the government and they basically give out pet projects and they spend money, they funnel things through nonprofits. I believe this is all true because, the amount of tax revenue that has been raised over the last 5 years is incredible. And we need to be able to track and see where all of that money went so we can figure out how to get rid of it. But I don't think at the same time you need to cut property taxes completely. I'm not sure forcing the hand is the right way to do it. Certainly wouldn't be the way that I would do it. But I think there are consequences when you do that. And there's a difference between taxation on the local level versus the state level. The state level obviously collects a sales tax of, in certain areas, if it's combined with the locals up to 7%. But I think it's important to look at that and consider it. But each area is so unique and different, but I'm not a fan personally of the property tax proposal here in Florida. I'm not sure what's going on in Texas, but I know there's some other states that are trying to do the same thing, which I like it. I don't like paying taxes either, but I'm trying to find a way that makes sense financially for these local governments to continue to operate, but for us still not to have all this waste. And I think really what needs to happen is voters need to get involved and actually vote correctly for people who have competent management skills. And I don't think we see a lot of that in these local areas. Unfortunately, it's usually like a popularity contest versus who actually has the ability to run things effectively and really competently. They'll do anything to lower the rents. Yes. Big buy switch to build to rent model several years ago. That's why a lot of new rentals popping up everywhere. They aren't luxury. They're just new. Yeah. Build to rent is great for renters because there's a ton of inventory coming on and it's causing rents to come down. So in Florida, we have them everywhere, entire communities of, 200 to 300 homes. So it makes sense because the companies who are doing these build to rent models, they can get, one loan for the entire community, and it can be, economies of scale, and they can get lower financing, and it just, the numbers make sense for them, and they can they can buy them at such a lower price than they were buying them before. So I think it's a good thing in a lot of cases that they have these build to rent products. 30% of gross and not even net. Yes, that's 37% of gross. Me, John the Don. 30 fixed is a cash grab for lenders, even at 3%. All the interest is front loaded, so you can realistically pay around 5 to 10% because you're the average house for 5 to 10 years. Yep, that's right. That's exactly right. A lot of people don't know how amortization works. It's a huge problem. 10 to 15-year mortgage is a sweet spot, but good luck affording one at those housing prices. That's right. Yep. Makes sense for your family. That's what counts. What are you seeing in the Florida beachfront market? So Kathleen Murray, great question. Florida is very unique depending on the area, how much demand there is for the area and how much land there is left to build in the area. We're seeing some areas, you drive down Palm Coast, you see a for sale sign every third house and there's nothing there. There's no jobs there. You're just living there as a second home, or you're there for a vacation home. But then there's areas like Jacksonville where there's no more land to build. There's tons of demand, and the housing prices are staying up. So it really just depends on where you are specifically. And also in South Florida, you're seeing a lot of this happen too, because a lot of the people who are coming in and buying these properties were from immigrants, immigration, Canadians, whatever, Chinese, Brazil, etc., who are buying these mega mansions on the water. And that demand has gone down drastically. So the beachfront market is getting hit in certain areas, but not so much hit in other areas. We have more inventory. Some fly off the shelves. Some just sit. We're 35 days market. 35-day market is nothing. Okay. Back in 2019, we had a 90 to 120-day market. So this is really, I think it's a great comment. When you put things in perspective, we're still just at the beginning phases of this market cycle shift, and we have a lot more to go moving forward. Rental homes are still high in Tennessee, needed 25% decrease, make it affordable. Again, same thing with leases. It takes time for the lease prices to come down because people are sometimes locked in for more than a year, even 2 years. So, it's going to take time for the demand shifts to happen and for, these owners to reduce the rents. In some cases, they'd rather just have the unit sit vacant for a couple of months than, try to have to decrease the rent because of the financing issues. So yeah, the fabric is starting to unravel with those who bought 3 years ago and don't have the money for repairs in their stretch. Then yeah, these are called the Instagram people that I like to reference to them as. They wanted to do an Airbnb. They got their license to manage it. They're a full-time professional. They did it, just so they could document it and look cool to people that they're managing an Airbnb, which is actually a really hard job in a lot of cases. If you just have one and you don't have a big management team, you're basically managing a hotel room and it's a lot of work for a little bit of money. So I feel bad for a lot of people that didn't do it at the luxury level and they just bought like a random Airbnb. A lot of these Airbnbs now are being turned back into long-term rentals. They are figuring out the math doesn't work as a long-term rental, and then they're being sold for very, very challenging prices. And a lot of people got swooped out of the money that they had put into it. So I feel for them. They got caught up in the rush, which a lot of people did, but I don't think it's going to get better anytime soon. So that, folks, I want you to have an awesome weekend. If you have any questions, I'm going to drop my email in the chat, and you can email me if you're looking for a top real estate agent. You just want to chat. You're looking for help with a short sale. You know somebody who needs some help. We also have somebody who specializes in assumable mortgages. So if you're looking for assumable mortgage, you have the credit quality to be able to do that. You have the cash funds to be able to make up the difference. Reach out. I'm happy to put you in touch with some really great operators out there that can solve a lot of these problems. But, it's my lookout when I look and did the math for what the market is. I think it's actually worse now in Florida specifically. I saw prices from the peak of 2022. Prices would need to come down 31 to 42% for the math to start making sense again to be a buyer as an investor, which I think is the backdrop number. And that was before rent started dropping. So it's actually less so now. And I think this stuff doesn't play out in the timeframes that you want it to or that you think it will, because there's just so many variables. I mean, who could have imagined oil prices where they are right now just, a couple of months ago? So I think this is a really important time to think, we don't have all the answers. We don't know. We can look at the fundamentals and we can think what they're saying moving forward, but it's going to be a challenging market moving forward. And I will be keeping you up to date every step of the way. Again, reach out if you want to connect. If you have any questions, email, and have a great weekend. And I'll connect with you both for everybody here on Friday next week for a live, and then Tuesday we'll come out with another video. Thanks so much. Have a great weekend.